The letter came in an envelope with the bank's name printed in the upper left corner. No handwriting on the outside. Just a window and your name showing through it. Most people set it on the kitchen table before they opened it, not because they were afraid, but because something about the weight of it told you not to read it standing up. It was March 1983. Planting season was 6 weeks out. The letter said the bank was reducing operating lines of credit across the county, effective immediately, not eliminating them, just reducing them, 20% for some, 30 for others. The language was careful, the kind of careful that keeps lawyers comfortable. It cited interest rate exposure, declining land valuations, and something called portfolio rebalancing. It closed by saying the bank remained committed to supporting the agricultural community. Nobody shouted. Nobody drove down to the bank and threw the letter across the counter. They just sat there at kitchen tables across 4 counties doing the same math: seed, fuel, fertilizer, parts. 6 weeks, and now a hole where the money was supposed to be. I remember when our operating line got shortened. You don't feel it like a door closing. You feel it like the room getting quieter. To understand what happened next, you have to understand what an operating line of credit actually does on a working farm. It is not a long-term loan. It is not the mortgage on the land. It is the money that gets you from March to October. You draw on it in spring to buy inputs, seed corn, anhydrous ammonia, diesel, herbicide. You pay it back after harvest when the grain check comes. The bank earns interest on the float. You get the inputs you need before you have the income to pay for them. That timing gap between when you spend and when you earn is the entire engine of row crop farming. Without liquidity in April, there is no crop in October. Without a crop in October, there is no income in November. Without income in November, the operating line doesn't get repaid, and the next spring, the bank doesn't offer one at all. Profit doesn't plant seed. Liquidity does. In 1983, the banks were caught in their own timing problem. Interest rates had run above 15% through the early part of the decade. Land values, which had been collateral for most of the loans on the books, were starting to soften. Banks weren't reducing credit lines out of cruelty. They were trying to reduce their own exposure before the dam broke. The math made sense from where they were sitting. From where a farmer was sitting in March, the math looked different. The quiet panic didn't announce itself. It moved through feed stores and co-op parking lots in the early mornings. A man you'd known 20 years would mention, offhand, that he was thinking about selling the old planter, or that he might cut his corn acres and let some ground sit, or that he'd talk to the elevator about a forward contract at numbers he'd never have accepted in a normal year. That's how it starts, not with bankruptcy filings, with small compressions, with farmers taking whatever cash they could find and parking it in the safest place they could see, which sometimes meant selling equipment they still needed at prices that guaranteed they'd pay more to replace it later. Earl Hutchins watched this from a gravel road outside of Crane County. He wasn't a large farmer, ran about 800 acres, cash rented half of it, owned the rest outright, or near enough. His operating line had been cut by 25%, which left him about $40,000 short of what he needed to put a full crop in the ground. He had some savings, not enough, He could cut his acres, but cutting acres meant cutting income, and he was already thin. He sat on that problem for about a week. Then, one evening, he drove over to his neighbor Dale Fitch's place and asked if he could come in. Dale had gotten the same letter. So had Merle and Spash, 2 miles east. So had the Reinhardt brothers, who farmed together and shared a single operating line. And so had Connie Voss, a widow who'd been running her late husband's operation for 4 years and had built it into something people in the county respected. Earl didn't come to Dale with a plan. He came with a question. He asked, "Between all of us, is there cash sitting somewhere that isn't working right now?" Dale didn't answer immediately. That's worth noting, because the question, when you heard it the first time, sounded like the beginning of something you weren't sure you wanted to be part of. I remember what it felt like when someone asked to pool money with neighbors. You trust them with your fence line, your equipment, your word. Money is different. Money makes the relationship complicated in a way that's hard to undo if something goes wrong. Over the next 2 weeks, Earl had quiet conversations with each of the four. He wasn't asking anyone to give anything. He was asking whether a small, informal pool, a shared liquidity reserve, made more sense than each of them separately trying to scrape together inputs at the worst possible time. The concept was simple. Each member would contribute what they could spare, anywhere from $5,000 to $15,000, into a shared account. Members could borrow from the pool for operating expenses at a rate below what the bank charged, with repayment due after harvest. The pool would hold a small reserve against default, and every decision about lending from the pool would require agreement from at least 3 of the 5 members. No contracts, not at first, just a handshake and a notebook. Connie Voss asked the question everyone was thinking. What happens if someone can't pay it back? Earl didn't have a clean answer. He said the group would have to decide together whether to extend, restructure, or absorb the loss. He said the pool wasn't designed to survive a catastrophic default. It was designed to handle timing gaps. The same timing gap the bank had always handled, except now the bank wasn't willing to handle it. That distinction mattered. They weren't trying to replace a bank. They were trying to fill a gap the bank had just created. Merle Anspach was the last one to agree. He said he didn't like the idea of his neighbors knowing exactly how much cash he had sitting around. Earl said that was fair, and that nobody was required to disclose more than they chose to contribute. The pool would know what was in it. Nobody needed to know whose money was whose once it went in. By the first week of April, the pool had $63,000 in a joint savings account at a small bank 2 towns over, not the same institution that had sent the letter. Trust is risk. Every one of them knew that. They went in anyway. The first draw came from Dale Fitch. He needed $11,000 for seed corn and herbicide. He had a standing order with his seed dealer, but the dealer was requiring payment up front that year, a change from the previous arrangement, which had allowed 30-day terms. The dealer had his own reasons. His own bank had tightened too. Dale brought the request to the group. Earl and Connie and one of the Reinhardts agreed. The money moved within 2 days. Dale planted on schedule. His neighbors, driving past his fields in late April, didn't know anything different had happened. That's the thing about liquidity when it works. You don't see it. You only notice it when it's gone. The bank noticed something, though, not immediately. But when Earl's operating line activity slowed, fewer draws, smaller amounts, a loan officer named Gerald Hess called and asked if everything was all right. Earl said yes. He said he was managing inputs more carefully this year, which was true. Gerald Hess didn't push, but Earl knew the call wasn't just friendly. By June, the pool had made 3 loans: Dale's seed purchase, a fuel draw for the Reinhardt brothers, and a smaller loan to Merle and Spash for a fertilizer application he'd delayed from spring and needed to put down before the window closed. All 3 loans were on schedule. No drama, no missed payments. But the county was not so quiet. Word had gotten around. The way word gets around in small communities, which is to say, imprecisely and with embellishment, that some farmers in the area were pooling money outside the bank. The story had grown by the time it circulated back to Earl. In one version, he'd organized a credit union. In another, he'd gotten people to sign over equity in their land. Neither was true. But truth doesn't travel as fast as a good story. A deacon at the Methodist church asked Earl after services one Sunday whether what he'd heard was accurate. Earl said he'd started a small, informal arrangement with a few neighbors to manage cash flow through the season. The deacon said he hoped Earl knew what he was doing. Earl said he hoped so, too. Most farms don't die from losses. They die from timing. He'd said that to himself so many times that summer it had stopped feeling like an insight and started feeling like a weight. August arrived, and with it, the first real tension inside the group. Merle Anspach's corn crop had not come in the way he'd expected. A stretch of dry weather in July, followed by an early season pest pressure he hadn't caught until it had done damage, left 2 of his best fields looking thin. The projections he'd shared with the group in April, which had formed the basis for estimating his ability to repay, were now optimistic by a significant margin. He didn't hide it. That was the thing. He drove out to Earl's place on a Tuesday evening and laid it out. Yield estimates down by roughly 30% on those 2 fields. Still projected to cover his input costs. Still projected to repay the pool loan. But the margin was narrow. If basis moved against him between harvest and when he sold, it might not be enough. The group met that weekend. No formal agenda. Just 5 people sitting in Earl's machine, shed with the big door open. What they were really deciding was whether the structure they'd built could hold stress. A pool that only works in good conditions isn't a liquidity tool. It's a fair weather arrangement, which is almost useless. They agreed to let Merle's repayment extend to January, past the typical October deadline, to give him more time to sell into a better basis. They adjusted the terms to add a small additional interest charge on the extended period. Not punitive, just enough to acknowledge that the group was carrying additional risk. And they agreed that if Murley's final sale came in short, the group would absorb the difference proportionally, up to a fixed ceiling. It wasn't comfortable, but it held. Harvest came in October. Corn prices were not good that year, nothing like the highs of the late 70s. But the group had not been betting on prices. They had been betting on timing. And on that bet, they had won. Dale repaid his seed loan in full, plus interest, in the first week of November. The Reinhardts followed. Merle's extended repayment came in during December, just short of his original projection, but within the range the group had anticipated. The shortfall was absorbed, split among the members, totaling less than $800 per person. When the dust settled, the pool had earned a small net return on its deployed capital and had helped four farms stay fully planted through a season where, without it, at least two of those farms would have cut acreage significantly. It wasn't a triumph. It was barely noticeable from the outside. But the $63,000 had done what the bank's reduced line could not. It had been available in April when it mattered, instead of theoretical in November when it didn't. Liquidity buys time. That's all it does. But time, in farming, is everything. By February 1984, the group had quietly grown. Two additional farmers had asked to join, neighbors who had heard the general outline of what had happened and wanted to understand it better. The group set terms for new members: a minimum contribution, a probationary period, and agreement to the same operating rules the original five had established. Earl wrote the rules down for the first time that winter, not because he distrusted anyone, because writing them down meant the rules existed independent of any one person's memory, and that mattered if the group was going to outlast the current moment. The 1984 planting season went smoother. The bank's operating lines remained reduced. The broader credit environment hadn't improved, and land values had continued to slide. But the pool had grown to nearly $90,000, which gave the group real flexibility. They set a maximum single member draw at 20% of total pool capital. They established a reserve requirement. 10% of the pool had to remain undeployed at all times. They started keeping more formal records. It still wasn't a bank. It wasn't trying to be. The foreclosure wave hit the county in the second half of 1984 and ran hard through 1985. It didn't come all at once. It came in sequences: a farm sale notice in the legal section of the weekly paper, then another, then a name you recognized, then a family that had been in the county for 3 generations, selling out because the operating debt had stacked too high over too many years, and the land value that was supposed to backstop it had dropped below the loan balance. I stood at a fence line once and watched a neighbor I'd known since I was 12 years old load the last of his equipment onto a flatbed. He didn't look at me. I didn't call out to him. There was nothing useful to say. The math had come to its end, and the math didn't care about the years. Of the 7 farms in the cash pool during 1984 and 1985, none went into foreclosure. That's not a coincidence, but it's not a miracle either. The pool had done one specific thing. It had allowed each member to stay planted, stay producing, and avoid the forced liquidations that created the debt spiral in the first place. Every farm that sold equipment below replacement cost in 1983 to cover a cash gap paid a second time when they had to borrow to replace it. The pool members hadn't avoided hard years. They'd avoided compounding bad decisions onto bad circumstances. There's a difference. It matters. By 1986, the pool had 7 full members and 2 associate members, farmers who participated occasionally but didn't hold a full share. The total capital had grown to just over $120,000, built partly from accumulated interest earnings and partly from new member contributions. The relationship with the banks had changed too, not adversarially. The original bank had eventually stabilized its lending policies as the broader interest rate environment calmed. Some pool members had gone back to relying on their operating lines for a larger share of their input financing. but none of them had gone back to full reliance. They kept the pool as a secondary layer, a cushion, a place where liquidity existed that didn't depend on a single institution's quarterly review of its portfolio. Gerald Hess, the loan officer who had called Earl in 1983, asked him about it at a Farm Bureau meeting that year. Earl explained it plainly. Hess said he wasn't sure it was fully legal, which Earl acknowledged. And then Hess said he supposed it depended on how you structured it. And then neither of them said anything else about it. The structure was informal. That was both its weakness and its resilience. A formal institution can be regulated, audited, closed. A group of neighbors with a joint savings account and a notebook of handwritten rules occupies a different kind of space. What Earl Hutchins understood, and what he couldn't have fully articulated at the beginning, was that the 1983 crisis was not primarily a profitability crisis. The farms that failed in that period were not, by and large, failing farms. Many of them had been profitable in recent years. What they lacked was the ability to bridge the timing gap between when money went out and when money came in, at the exact moment when the institution that had always bridged that gap pulled back. The bank's logic was defensible. When land values fall and interest rates are high and commodity prices are uncertain, a prudent lender reduces exposure. That's not villainous. That's how risk management works from the inside of a balance sheet. But that same risk reduction, applied across an entire lending portfolio at the same moment, concentrated the crisis. Every farm that had used that bank for operating credit faced the same gap at the same time. The bank had reduced its own risk by distributing the problem outward into the community it served. What the cash pool did was distribute the risk differently back among the people who shared the same soil, the same weather, the same market exposure. They were not diversified. Nobody would recommend this structure as a model of sound finance. But in the specific conditions of spring 1983, it solved the specific problem. It moved liquidity from where it was sitting idle to where it was needed immediately. Institutions reduce risk by concentrating it. Communities reduce risk by distributing it. Neither approach is always right. Both approaches carry their own failure modes. But in a moment when the institutional approach had produced a uniform gap across an entire rural economy, the community approach filled that gap in a way no individual farm could have managed alone. Years later, Earl still ran the pool. It had changed shape. Some of the original members had retired and passed their shares to children who continued farming. Some had sold and moved on, cashing out their contributions. New members had come in. The capital had grown and shrunk with the years. It never became more than what it was, a shared liquidity reserve among a small group of farmers who had learned in a hard spring that timing kills farms, and that the cure for a timing problem is available cash, not projected profit. He kept the notebook, the original one, with the handwritten rules from 1983. The ink had faded on some of the pages, and a few of the terms they'd set had been revised over the years. But the first entry was still legible. 5 names, a date in April, and a number. $63,000. Not enough to save a county, enough to save the people in that room. I think about that a lot now, not just in farming. Wherever you are, whatever you're running, a small business, a contractor operation, a service company, there is always a gap between when you spend and when you collect. That gap has a name. It's called a liquidity need. And the way most people fill it is by handing that problem to a single institution and hoping the institution doesn't change its mind. Most of the time, the institution doesn't change its mind. Most years that works. But the question worth sitting with is this: if the letter came tomorrow, if your operating line was cut, or your credit facility was reduced, or your primary lender decided your category of business was no longer one they wanted exposure to, what would you do in April? Not in November when the money is coming. In April, when you need it first. Who would you call? What would you have available? And how many of the people around you are carrying the same exposure, invisible until the day it isn't? Profit doesn't plant seed. Liquidity does. Timing kills farms. It kills businesses. It kills careful people who had good years and no cushion. Earl Hutchins wasn't a visionary. He was a man who understood a timing problem and found 4 people willing to carry it with him for one season. That was enough to get through the year. Getting through the year turned out to be enough to get through what came next. That's how survival usually looks. Not dramatic, not heroic, just one decision made early enough, with enough people standing together to matter when it counted. If stories like this still matter to you, the structural ones, the quiet ones, the ones that explain why some people made it and some didn't, stay with me. There are more of them to tell.